What if I told you one of the most popular dividend ETFs is down nearly 5% from its recent highs? That's right. The darling of dividend investors, SCHD, has been dropping like a rock in 2025, leaving many wondering, is this the end of the SCHD era or the buying opportunity of a lifetime? Today, we're diving deep into why SCHD is dropping in 2025, what's happening behind the scenes, and most importantly, whether this dip represents a golden opportunity for long-term investors. If you've been considering adding this fund to your portfolio or already own shares, you absolutely need to watch this video all the way through. Before we jump in, let's look at where things stand. As of March 11th, 2025, SCHD's price sits at $27.69, down from $29.62 at its 52-week high. That's a drop of nearly 7%. Not catastrophic by market standards, but certainly enough to catch attention, especially for a fund known for its stability. For those who might be new here, SCHD is the Schwab U.S. Dividend Equity ETF, a powerhouse in the dividend investing world that tracks the Dow Jones U.S. Dividend 100 Index. With approximately $69.2 billion in assets under management, it's become a cornerstone investment for income-focused investors. But here's what has people worried. After years of reliable performance and growing dividends, SCHD seems to be stumbling in 2025. And naturally, investors are asking, is this just a temporary blip or a sign of deeper problems? To understand why SCHD is falling, we first need to understand what makes up this ETF. Unlike a total market fund, SCHD's holdings are carefully selected based on specific criteria. The fund currently holds about 103 stocks, with the top 10 positions making up approximately 42 to 45% of the entire portfolio. That's a fairly concentrated approach compared to some other ETFs, which means changes in just a few key holdings can significantly impact overall performance. Looking at SCHD's sector weightings, we see the fund is most heavily allocated to financials, 17.7%, healthcare, 17.6%, consumer staples, 14.8%, industrials, 12.5%, and energy, 11.8%. Technology, which has been a major market driver, represents only 8.9% of the fund. One of SCHD's distinctive features is its focus on companies that not only pay dividends, but have a history of increasing them. This quality-focused approach has historically helped SCHD deliver both income and growth, creating a powerful combination for long-term investors. Why SCHD is dropping? So why exactly is SCHD dropping in 2025? Let's break down the three main factors. First, we're seeing rotation out of value stocks and into growth sectors. SCHD's methodology emphasizes companies with strong financial health and dividend track records, which tends to skew toward value-oriented sectors. In contrast, the broader market, particularly the S&P 500, has been increasingly dominated by growth-oriented technology companies. Looking at the data, while SCHD delivered an impressive 10-year annualized return of about 11.6%, the S&P 500 returned roughly 12.6% over the same period. This performance gap has widened in periods where tech and growth stocks outperform, like we're seeing in early 2025. Second, rising interest rates have disproportionately affected dividend stocks. When yields on safer instruments like treasury bonds increase, high dividend stocks become relatively less attractive for income seekers. Many of SCHD's financial and utility holdings are particularly sensitive to interest rate movements. Third, SCHD's reconstitution and rebalancing can create temporary pressure. The fund underwent its annual reconstitution recently, which may have led to selling pressure on stocks being removed and potential inefficiencies as new additions are incorporated. Sector performance impact. Let's look more closely at how SCHD's sector allocations are affecting its performance. Financial stocks, which make up 17.7% of SCHD, have faced headwinds due to concerns about loan quality and compressed margins in certain banking segments. Healthcare, another significant portion at 17.6%, has underperformed amid regulatory pressures and drug pricing concerns. Meanwhile, energy stocks, 11.8% of the fund, have been volatile with shifting oil prices and the ongoing energy transition. Consumer staples, 14.8%, traditionally a defensive sector, has struggled with inflation pressures and changing consumer behaviors. In contrast, the technology sector, which comprises just 8.9% of SCHD, has been a market leader. SCHD's underweight position relative to the broader market has created a significant performance drag. SCHD's historical performance shows it tends to lag during tech-driven rallies, but often outperforms during market downturns or value-oriented cycles. For instance, in 2022, when the S&P 500 fell 18%, SCHD declined only 3.2%, demonstrating its defensive qualities. Dividend strength. Despite price weakness, while SCHD's price may be declining, it's crucial to note that its dividend remains strong, perhaps even more attractive due to the recent price drop. Currently, SCHD offers a dividend yield of approximately 3.5 to 3.8%, significantly higher than the S&P 500's yield of about 1.5 to 1.7%. This means for every $10,000 invested, you're generating roughly $350 to $380 in annual dividend income. Moreover, SCHD has an impressive dividend growth rate. The fund has increased its dividend every year since inception, with a 10-year average growth rate of about 11 to 12%. Just last year, the total dividends paid increased by approximately 12.2% compared to 2023. For long-term investors, this combination of yield and growth is powerful. Even if share prices temporarily decline, those steadily increasing dividend payments provide both income and the opportunity to reinvest at lower prices, potentially boosting long-term returns. How to approach SCHD now? So the big question, what should investors do with SCHD right now? Let's explore 3 potential strategies. Strategy number 1, dollar cost averaging. For new investors or those looking to add to existing positions, the current dip may present an opportunity to start dollar cost averaging into SCHD. By investing fixed amounts at regular intervals, you can potentially lower your average purchase price over time. Let's look at an example with Harry. If Harry invests $1,000 in SCHD every month over the next 6 months, regardless of price fluctuations, he'll effectively build a position at an average cost that smooths out the volatility. Strategy number 2, yield on cost focus. For dividend investors, the current situation actually improves SCHD's yield on cost potential. With the share price lower and dividends remaining strong, new investments capture a higher initial yield, which then has the potential to grow over time through dividend increases. For example, if SCHD's current yield is 3.7% and the dividend grows at its historical rate of approximately 11% annually, an investment today could be yielding over 10% on the original cost basis in just 10 years. Strategy number 3, portfolio pairing. Another approach is to pair SCHD with complementary ETFs. For instance, combining SCHD with a growth-oriented ETF could provide balance, allowing you to capture both dividend income and growth potential. Harry could create a balanced portfolio by allocating 60% to SCHD for income and value exposure, and 40% to a growth-focused ETF to capture technology and innovation trends. This pairing strategy helps address SCHD's underweight position in growth sectors while maintaining strong dividend income. Long-term performance perspective. While short-term prices fluctuate, long-term perspective matters. Over the past 5 years, SCHD delivered 12.5% annualized total returns. $10,000 grew to $18,000 with dividends reinvested. Over 10 years, returns were 11.6% annualized. $10,000 became roughly $30,000. SCHD shows resilience during downturns with a beta of 0.88, making it less volatile than the market. This contributes to strong risk-adjusted returns with a 10-year Sharpe ratio around 1.1. Looking ahead, while past performance doesn't guarantee future results, SCHD's focus on strong dividend histories suggests it remains well-positioned for long-term investors seeking balanced income and growth. 10 o'clock. Numerical examples, SCHD investment projections. Let's put some real numbers to this. I want to show you exactly what a $10,000 investment in SCHD might look like over different time horizons, using the data and historical performance we've discussed. For these projections, we'll use conservative estimates based on historical data. An average share price appreciation of 7.5% annually, slightly below SCHD's historical average, and dividend growth of 10% annually, also slightly below historical rates. We'll assume dividends are reinvested, starting with $10,000 today at the current price of $27.69. 5-year projection. Initial investment, $10,000. Approximate shares purchased, 361 shares. Value after 5 years, approximately $14,400. Annual dividend at year 5, about $540. Total value with reinvested dividends, approximately $15,900. 10-year projection. Value after 10 years, approximately $20,700. Annual dividend at year 10, about $1,380. Total value with reinvested dividends, approximately $26,800. 20-year projection. Value after 20 years, approximately $42,700. Annual dividend at year 20, about $9,000. Total value with reinvested dividends, approximately $87,230. Year projection. Value after 30 years, approximately $88,200. Annual dividend at year 30, about $58,800. Total value with reinvested dividends, approximately $371,500. These projections illustrate the power of compound growth and reinvested dividends over time. Even with conservative growth assumptions, a relatively modest initial investment of $10,000 could potentially grow to a substantial sum over several decades. SCHD versus alternative dividend ETFs. To provide context, let's compare SCHD to some alternative dividend ETFs. When compared to Vanguard's High Dividend Yield ETF, VYM, SCHD has historically outperformed over the past decade, delivering about 11.2% annualized versus VYM's 10.0%. SCHD also showed stronger dividend growth, though VYM offers slightly more diversification with over 400 holdings. Against iShares, select Dividend ETF DVY, SCHD again demonstrated superior total returns. While DVY has a slightly higher current yield, SCHD's combination of yield and growth has resulted in better long-term performance. Compared to the Vanguard Dividend Appreciation ETF, VIG, which focuses more on dividend growth than high current yield, SCHD has offered a higher income stream but similar total returns over the long term. What sets SCHD apart is its balance of current income and growth potential, along with its remarkably low expense ratio of just 0.06%. This efficiency helps investors keep more of their returns over time. While SCHD offers compelling advantages, it's important to understand the potential risks. First, sector concentration risk. With significant allocations to financials, healthcare, and consumer staples, SCHD is more exposed to these sectors than a broader market fund. If these sectors continue to underperform, SCHD could continue to lag the broader market. Second, interest rate sensitivity. Many dividend-paying stocks are affected by interest rate changes. If rates continue to rise, this could create further headwinds for some of SCHD's holdings. Third, changing market dynamics. SCHD's underlying index methodology, which emphasizes dividend history and financial strength, may not capture emerging growth opportunities in the same way as broader market indices. Finally, there's the risk of dividend cuts. While SCHD focuses on companies with strong dividend histories, economic challenges could potentially force even well-established companies to reduce their payouts, which would impact both income and potentially share price. Is SCHD a buy in 2025? So, is SCHD a good buy in 2025? For long-term dividend investors, the current dip may be attractive. SCHD offers a compelling combination of a 3.5 to 3.8% yield, double-digit growth, quality holdings, and a low 0.06% expense ratio. However, if you seek maximum short-term growth, SCHD's sector positioning may be a headwind. Consider a balanced approach. Ultimately, the decision depends on your goals, time horizon, and risk tolerance. For patient, long-term investors valuing both income and growth, SCHD's weakness may offer an opportunity to build or add to a position. If this helped, hit like and subscribe. Are you buying, holding, or selling SCHD? Let me know below. Happy investing!